A standard financial graph typically uses a line chart to track asset prices over time. It connects a sequence of single data points, the final closing price for a given period, to create a smooth path from left to right. This view omits the vast majority of the story. By highlighting only the endpoint, the chart erases the volatility, fear, and greed that drove the market to that final number. Every price movement represents a primal tug-of-war. Buyers attempt to pull the price higher, while sellers fight to drag it down. Survival in the market requires the ability to read the physical footprints left behind by this constant struggle for control. To see the details of that combat, many traders look to the Japanese Candlestick, a tool designed specifically to map out the psychological warfare happening within every minute of the day. Visualizing how these footprints are forged requires isolating a single slice of time. We'll use a 5-minute trading window, starting the exact second the clock starts. The moment the timer begins, the first recorded transaction creates the open. This provides the baseline starting price for the period. If buyers take aggressive control, they drive the price upward toward a temporary peak. This extreme upper boundary, the highest price reached during the 5 minutes, is marked as the high. Should sellers retaliate, they rip control away and drive the price in the opposite direction, crashing past the starting point and dropping into the lower half of the grid. This extreme lower boundary, forced by the sellers, is recorded as the low. As the active price swings between these extremes, it leaves behind thin vertical lines connecting the high and low to the center. These are the wicks, or shadows. These wicks serve as the literal scars of battle. They show the maximum territory the losing side managed to claim before being violently pushed back. When the 5-minute timer expires, the final recorded price is locked in as the close. This is the final anatomy of a candlestick. The space between the opening price and the closing price solidifies into a thick central block called the body. The color indicates the victor. A green body means the close was higher than the open, signaling buying strength. A red body means the price dropped, giving the round to the sellers. The vertical size of this body reveals the exact margin of victory for the winning side. The resulting candlestick records the entire event. The body declares the ultimate winner, while the wicks capture the psychological extremes of the fight. If a single candlestick is a letter, an entire chart forms a complete sentence. This sequence shows a specific sentence indicating extreme market rejection. A series of red candles moves downward, hitting a critical conflict point. Analyze the anatomy of this circled hammer candle. It features a tiny green body at the top and a massive lower wick. The physical evidence tells the story. Sellers attempted to drag the price into the abyss, creating that deep downward shadow. Then, buyers stepped in with overwhelming force, pulling the price back up to close higher than it opened. This footprint signals total exhaustion from the sellers. Failing to defend their ground, the pattern acts as a reliable predictor of an imminent upward reversal. Mastering the anatomy of the open, high, low, and close allows you to decipher the raw psychology of the financial battle.